On April 7th, at 5:32 p.m., Donald Trump announced a ceasefire with Iran. This single declaration revealed two critical insights. First, Truth Social proved itself to be the greatest invention of our generation, or so the narrative goes, rather than just another social media platform. Second, markets despise uncertainty. The very next day, the financial markets surged. The S&P 500 climbed 2.5%, the Nasdaq rose nearly 3%, and the Dow Jones Industrial Average added over 1,300 points, marking its best single-day performance in nearly a year. Yet, the momentum didn't stop there. Within weeks, stocks hit record highs, even as the ceasefire began to unravel in real time. While traditional financial media framed this as a relief rally, the reality was far more complex. To understand how markets reached all-time highs amidst active geopolitical conflict, we must look at the state of Wall Street leading up to that moment. On February 28th, the U.S. and Israel conducted joint airstrikes on Iran. Following the death of Supreme Leader Ali Khamenei, Iran closed the Strait of Hormuz. The market entered its worst 5-week losing streak in nearly 4 years, with the S&P 500 down nearly 9% by the end of March. Beneath the surface, Wall Street was gripped by panic. Hedge funds were liquidating assets at their fastest pace in 13 years. Goldman Sachs, acting as a prime broker for major firms, had a front-row seat to the chaos. Their data showed that North American hedge fund selling in Q1 was the heaviest since April 2020. Gross leverage hovered above 300%, and short exposure to macro ETFs like SPY and QQQ reached pandemic-era highs. On March 19th, commodity analyst Rory Johnston warned that a supply chain detonation in the Middle East would create a shockwave too large for the global system to absorb. He noted that even in a scenario where the Strait of Hormuz remained closed, the world would need to shed 15 million barrels of demand per day, likely pushing oil prices toward $250 or $300 a barrel. He described the potential fallout not just as a recession, but as a depressionary event. Yet, 6 weeks later, the market sentiment flipped entirely. When Trump announced the ceasefire, the markets reacted as if a liquidity floodgate had opened. Over 400 S&P 500 stocks finished in the green, 13 stocks hit all-time highs, and Brent and WTI crude oil prices dropped significantly. However, the mainstream narrative of a peace-driven rally breaks down when you examine the data. According to maritime intelligence firm Windward, traffic through the Strait of Hormuz remained down by roughly 96% compared to pre-war levels. There was no actual restoration of world peace, so what truly moved the markets? It was a textbook short squeeze. When investors short a stock, they borrow shares to sell, betting on a price decline. If the price rises instead, they are forced to buy back those shares at a loss to cover their positions. As prices climb, these forced repurchases trigger margin calls, creating a cycle of buying that drives the price even higher. On April 8th, with macro short exposure at its highest level since 2020, this chain reaction began. Once the squeeze started, systematic trading firms known as CTAs, commodity trading advisors, kicked into gear. These firms operate on mechanical, rules-based models that prioritize trend following over geopolitical news. Reports indicated that CTAs held a $30 billion net short position heading into the ceasefire. As the S&P 500 crossed key technical triggers, these models flipped to long. Goldman Sachs originally estimated that CTAs would need to buy back $40 billion in equities, but the final figure reached $86 billion over just 5 trading sessions, one of the fastest buying prints in history. Finally, the options market accelerated the move. Dealers, forced to remain delta neutral, had to purchase underlying stocks to hedge against the surge in call options. With the market in a negative gamma regime, dealer hedging shifted from stabilizing to pro-cyclical, amplifying the rally. This pattern is not new. From Jerome Powell's patient pivot in December 2018 to the Bank of Japan's rate hike in August 2024, the catalysts vary, but the mechanisms remain consistent. The structure of the stock market has fundamentally shifted. 20 years ago, human analysis dominated. Today, 63% of U.S. stock funds are held by passive indexers who track markets on autopilot. Market cap weighting means that as companies grow, they receive more capital by default, regardless of their fundamentals. Meanwhile, the hedge fund industry has consolidated into a few massive multi-strategy firms that operate with high leverage and strict drawdown rules, forcing them to sell immediately when limits are hit. With same-day expiration options now accounting for 63% of SPX trading, over $2 trillion in notional value can shift in a single session. These options force dealers to hedge in real time, creating a feedback loop where market participants react to each other rather than to the underlying value of the companies. The stock market we once knew, one focused on long-term investment, has been replaced by a giant automated feedback loop. The headlines are merely the stories we tell to rationalize the chaos.